Many people believe that government spending leads to inflation. However, this is not necessarily the case. The real determinant of inflation is the willingness of the monetary authority to finance government spending by printing money. Inflationary finance, also known as seigniorage, can be an attractive source of revenue for governments. It is easy to collect and difficult to avoid, it can be implemented quickly, and its effects are not apparent to most people. However, there are limits to how much revenue can be generated through inflationary finance without causing runaway inflation. To understand how inflationary finance works, we need to distinguish between two factors that determine the tax revenue generated by a particular tax. The first factor is the tax rate, and the second is the tax base. In the context of inflationary finance, the tax rate is the inflation rate set by the monetary authority, and the tax base is the amount of real, inflation-adjusted, cash balances people hold. An essential determinant of the demand for money is the fraction of wealth people desire to hold in cash balances. This fraction depends on the relative attractiveness of holding wealth in the form of cash balances versus other assets like bonds. The yields on financial assets, like bonds, tend to increase with inflation, a phenomenon that economists call the Fisher effect. While the monetary authority sets the tax rate on cash balances by controlling the money supply, the public decides the amount of cash balances to hold. As the inflation rate increases, the relative price of the liquidity services a unit of cash balances provides decreases, and people hold fewer cash balances. Hence, there is an inverse relationship between the tax rate on cash balances and the amount of cash balances people hold. If a government runs a budget deficit so large that it can no longer raise revenue by increasing taxes or issuing bonds, it must turn to inflationary finance to cover the deficit. As a result, inflation will increase as the monetary authority prints the money necessary to finance the government's budget deficit. However, there is a limit to how much revenue the monetary authority can generate without causing runaway inflation. In most developed countries, seigniorage constitutes a small fraction of total tax revenue. These countries typically rely on broad-based taxes instead of inflationary finance because the costs associated with inflationary finance increase faster than those from other forms of taxation. Nonetheless, as long as central banks remain willing to help governments pay their bills, even countries with relatively efficient tax systems will rely on inflationary finance to a certain extent. In conclusion, while government spending does not necessarily cause inflation, inflationary finance can be an attractive source of revenue for governments. However, there are limits to how much revenue can be generated through inflationary finance without causing runaway inflation. Therefore, it is essential for governments to maintain a sustainable fiscal path and to rely on more traditional forms of taxation to reduce the overall harm that taxes cause. Subscribe Libertarian Facts.